This is Russell Riggin, President of Talent Financial Services and Financial Advisor with Raymond James Financial Services. We have a special episode of Uncomplicated Wealth today, and our guest today is Chad Dijic with BlackRock. Chad's been in many client meetings and spoken at many events that we've hosted at TFS, and really excited to have him on the podcast today. Chad's been with BlackRock for 14 years, and most of you know BlackRock is the largest asset manager in the world. They manage about $11.6 trillion. Since 1999, when the company started, the stock market's up 700%. BlackRock stock is up 7,000%. Obviously, they're doing something right. Chad has a lot of great insights. BlackRock's involved in a lot of great things that's going on right now. So we wanted to have him on the podcast to discuss some of the current events that are affecting our clients and the country. Chad, thank you for joining us.
Man, this is going to be fun. Thanks for having me. And I'm looking forward to the conversation. This will be great.
Awesome. Well, we're going to really go over three main topics today. We're going to go over the current events that are affecting the markets with the tariffs and rapid changes that DOGE is implementing in the country. We're going to touch on the infrastructure and what's going on with infrastructure spending, maybe the outlook we have for the country over the next 10, 15, 20 years that we personally are very excited about. And finally, we're going to touch on the latest Social Security change, which could affect a lot of people that we work with. Dad, let's start off with tariffs. When we look at tariffs, they're catching a lot of headlines. Obviously, in March of 2025, it's causing a lot of volatility, primarily because tariffs come with uncertainty. And the thing that the market likes the least is uncertainty with what's going on. We basically break tariffs down as to trying to accomplish four things. And I want your input on these. Is the first thing is decoupling. What the government's trying to do is shift the supply chains and reduce our dependency on certain countries, primarily China, when it comes to energy, pharmaceuticals, different types of materials, technology. Those are things that we're trying to bring back to the U.S. Rebalancing is the second thing that we're trying to do with tariffs, which is to reduce the trade deficits and increase domestic production. And we'll talk about that a lot here on infrastructure here in a minute. Negotiating, we're trying to create leverage for the United States through putting pressure to achieve certain policy outcomes and goals that this administration and previous administrations have actually had when it comes to foreign policy. And finally, funding. The fourth part with funding means that we're trying to generate revenue to help fund domestic policy priorities and create extra forms of revenue to help reduce the deficit that the United States currently has, which stands at about 36, 38 trillion, depending on what day you look and what numbers you're looking at. So, Chad, would you touch a little bit on with what's going on with the tariffs? What's BlackRock's view? What is y'all's long-term outlook of both the benefits and risk that could affect the market in the short term and potentially benefit everyone in the long term?
So first, I like the way you broke that down, right? So I don't need to go into a lot of detail. I'll kind of cover those points that you mentioned a little bit, but like Russell, I would back up to the key thing you said at the beginning of this conversation. Like what you're seeing happen with the markets is because of uncertainty. It's because of change. Like you think about things in your life, when something changes, it's not comfortable, right? You have to get uncomfortable to grow. And I think that's what's happening here. Like Russell, when I think about it, I think to be a successful investor, especially in this environment, it's really like I always tell the fishing story with my dad, right? Like I would go fishing with my dad on all the different lakes across Texas. That's awesome. That's fun. He took me in the Gulf of Mexico, Gulf of America, I guess I should say. And we went 4 hours out. I'm 10 years old, Russell. And when the boat stops and the boat is rocking side to side, and I panicked. And my dad saw me panic. And we're there with all of his fishing buddies from Anheuser-Busch. And he comes over, he puts his arm around me, was like, son, if you keep looking at the waves next to the boat, you're going to get sick. You're going to have a bad day. It's going to be awful. These guys are going to make fun of you forever. And we're not taking you back. And I was a witty little guy then. So I was like, well, what's option two? Because that sounds terrible. And he's like, son, you got to look on the horizon. Like focus out in the distance, right? Stop looking at the waves next to the boat. Now, of course, I didn't listen. I had an awful day. And those guys still do the gag reflex every time they see me. But Russell, I think about that like a lot. Like, I think that's what's happening now. We're all so hyper focused on what's happening right next to the boat, all the waves. Like, oh my goodness, look at these headlines. Oh, like, what is happening? Are we going to have a recession? And it's like we're taking our eye off the ball, like long term. What Trump is trying to accomplish is really to cut the government spending down dramatically and let the private markets, let the capital markets work. The government's not good at business. They shouldn't be in business. And so you got to scale the government down and you have to let private markets work. Larry Fink wrote an op-ed in the Wall Street Journal on election day to keep the politics out of it. And he said, we must grow our way out of the debt. And so, Russell, when you walk through those points, when you mention decoupling, that's really reshoring. Think about that. We want to get essential items. And we learned this during COVID. How painful was it when we needed pharmaceuticals and we needed chips? How many of you had a car that wasn't even complete? You bought a car in 2020 or 2021, but you were waiting on some chips. And when the chips came in, you had to take the car back to the dealer, right? I know my wife and I, we didn't buy a car because they were like, we don't have the chips, but you can take it. It's 75% done. You just bring it back later. I'm like, that's the most ridiculous thing I've ever heard. We can't have essential items made in a place like China. And so this reshoring effect is a really big deal. And then you talk about rebalancing the trade deficit. Like, it's embarrassing how the United States has been taken advantage of by all these countries. And so I think point 2 leads us right to point 3. This is a negotiation. We think in the short term, the tariffs will be high. The other countries will retaliate. But guess who has the most to lose? Everyone else. We have the best market. We have the best workers. We have the best economy. We have the best capital market system, free market capitalist system. Russell, we're going to win. And so these folks are going to have to come back and negotiate things down. And then what happens in a couple of years? Tariffs are lower across the world. And then you look at point 4, funding, like the debt. The biggest risk to our country for our kids and grandkids is the debt. It's unsustainable. If any of us managed our checkbook the way the government is, we'd be in jail. Like this cannot happen. It's unsustainable. Russell, in 2019, we have $18 trillion in debt. Today, we have $36 trillion in debt. We're still spending money like we're in an emergency, like we're in COVID. And I think what folks are going to find out in the short term is a lot of the growth that you've seen in the economy the last couple of years was just deficit spending by the government. So now you got to turn that off and you got to let the capital markets work. And so that's how I think about it. But I would just encourage everyone as investors, you have to be really careful looking at the waves next to the boat. You need to be focused on your long-term goals and plans, because I think in a couple of years, I think in 6 months, Russell, you see some big, big changes. And then if you think about Trump, there's urgency here, right? Why is there urgency? Because when a president is elected and they also win the House and the Senate, 90% of the time at the midterms, the House and the Senate flip to the other party. So he has a short window where he has to make these things happen, and it needs to go well. And that's I think what's unsettling to the market is when you have change, it's not good. But when you have really quick change, like really big changes, man, it's really going to move the market. So you're going to have a lot of volatility, and you've got to stop looking at the waves next to the boat and know what he's trying to accomplish long term.
Our theme within our office for our clients this year has been no pain, no gain. Whether you like Trump, love Trump, hate Trump, I can understand anyone's reasoning for how they feel about Trump. He's just a polarizing figure, and I get that. Whoever ultimately was going to cut spending in the United States, which we all agree needed to be done, they were going to be unpopular with a lot of people, and I understand that. The no pain, no gain comes in where anytime you start a change, whether you go on a diet, you're going to feel hunger pains until you get used to it and get settled in. If you start a new workout routine, whether it's lifting weights or walking or running or whatever it is, you're going to be sore for those first 6-8 weeks, but then you're going to start realizing the benefits to that. And I think the exact same thing can be said for the U.S. economy, and especially the stock market this year, where there are going to be some short-term ramifications, some short-term uncertainty, some short-term downward movement, volatility springing back upwards, because we don't really know what to expect. This hasn't been done in a significant amount of time, even though it was talked about under the Obama administration, done a lot under the Clinton administration, discussed under the Bush administration. It really has not been executed on, even though it's been talked about. And so there is going to be some uncertainty. I've been telling our clients, expect volatility. There's going to be a lot of statements you're probably not going to like this year, but I think the United States potentially could be setting itself up for a 20 or 30 year period of unprecedented success if things go like they are setting up to do.
Yeah, I love that metaphor, right? I started working out really hard at the beginning of the year, and it's not fun, right? Cold plunges, sauna, like that stuff's miserable, right? And so I love how you set that up. I think that's great.
Yeah, the next thing I want to talk about, something that we're extremely excited about that has just really got me amped up the past year, is infrastructure spending. And this is something that has a lot of bipartisan support inside the United States on the needs that we have as a country and what we learned in COVID and what we don't want to go back through, some of the things that you touched on. So since Trump was elected, there's been announcements of $1.7 trillion in infrastructure investment, capital spending within the United States. And it goes from Honda and the car industry. It goes to Apple, Taiwan Semiconductors, Intel, all building very big plants to bring chip production and technology back to the United States. Rivian on car manufacturing to go along with Honda. Eli Lilly is building a few extra plants for pharmaceuticals. There's a significant amount of investment that's going on in infrastructure in the United States. There's also a lot of positioning for building out the electric grids. The state of Texas is one of the ones with our ERCOT system that has to significantly invest in the amount of electricity that we're able to produce due to the data centers and AI being introduced into the state of Texas. Can you touch a little bit about how BlackRock's involved? I know that y'all have been very involved over the past year of investing in infrastructure. Talk to us a little bit about the recent Panama Canal announcement and also what you're doing with ERCOT.
So I'll back up a little bit and tell you, Larry Fink is one of the most visionary leaders I've ever seen, Russell. So I've done this in this business for 24 years, the last 14 with BlackRock. I've been fortunate enough to be on the leadership council and get to, understand Larry Fink and the way he thinks. And I'll back it up to, February of 2009 at the bottom of the market. We acquired iShares from Barclays during the financial crisis. Barclays had some financial issues. We actually acquired iShares, the ETF company, exchange traded funds, which are now what so many folks use for investments, lower cost, more tax efficient than mutual funds. And Russell, that deal was done in February of 2009. Now, if you think about that, that's right at the bottom of the market. The S&P was down 55% at that time. We paid $12 billion to buy $300 billion in assets from iShares. Today, iShares oversees $4.2 trillion. Okay. And a lot of people, when they first came out, they're like, who would want to buy an index? Who would want to buy an EFT? And I'm like, they're actually ETFs. And so it was like, we had to educate folks about it. Now, fast forward to February 6th of 2024. Larry Fink was sitting in Houston, Texas, at an energy summit that Dan Patrick, the Lieutenant Governor of Texas, put together. And he invited Larry Fink to attend because he thought Larry can help us. He can bring institutional investors to Texas to help us solve the grid. And it's not just the electric grid with ERCOT, it's also water. Water and electricity are what's going to limit Texas's growth, and we have to figure that out. So Larry Fink is sitting at this energy summit with Dan Patrick, hearing from all these different people talk about the issues with the infrastructure. And he thought, what an amazing opportunity to get involved with infrastructure. BlackRock's never really been an infrastructure firm. We manage mutual funds and ETFs and 401k plans and investments. And we've never really done the infrastructure deal. So Larry at that point leaves that meeting and says, we've got to make an acquisition that allows us to be one of the big players in infrastructure in the world. So we bought Global Infrastructure Partners. So we're not just saying these things, Russell. We're not just saying we need to grow our way out of debt. BlackRock has invested $27 billion in the last 6 months to acquire Global Infrastructure Partners and a private equity, private credit shop to make sure that we're the leader when capital markets and private markets start to solve the biggest issues, because it's going to serve the communities across the country. It's going to serve the people of Texas. it's also going to be amazing opportunities for investors to invest and make money alongside of the best companies in the industry, not just BlackRock. So Russell, that's really where it started. It was with Dan Patrick last February 6th, Energy Summit in Houston. We made this acquisition, and it goes back to what you said earlier about reshoring and chips. And we mentioned chips earlier. I didn't realize this. The average chip, when it leaves China, it crosses 70 different borders before it ends up in your smartphone.
Yep.
Think about that. How risky is that? Right? What if a canal gets blocked, a port gets shut down, whatever geopolitical risk may happen, weather issues? That is way too dangerous when our whole life and our whole system is going to run on chips. Everything you have in your home, your business, your car. Think about how many semiconductors are in these products. And so when you start reshoring, well, guess what? That's great. We want to reshore, but we don't have the infrastructure for this. And so that's where I think that the exciting stuff, Russell, is all the artificial intelligence and all the technology. Man, that's so exciting. All the growth ideas. We like the infrastructure side of it because it's more defensive. These are things we have to do no matter what. And so you tend to get more dividends. You tend to have more downside protection with market volatility because these are things that have to happen no matter what. So BlackRock is involved with Microsoft in data center deals. And then you heard this week, we did, this is an interesting deal. It's now public, so I can talk about this. But Larry Fink has been very involved with the administration and how we can help from the infrastructure side. So with this whole Panama Canal situation, Larry Fink was actually on vacation. He's sitting on the beach and he starts thinking about it. And he says, I need to reach out to Marco Rubio. So he reaches out to Marco Rubio. They have a conversation about this and talked about buying the ports on both sides of the Panama Canal to make it easier for the United States to actually, take control of the Panama Canal. So BlackRock actually purchased the ports on both sides of the Panama Canal from a Chinese company to bring that control back to a U.S. company. And this happened this week. And this is all part of this idea that you've got to reshore things. You've got to move things back to the United States. This will be a big deal for the U.S. This is going to help all of us. And so that's the type of acquisitions that we're making on the infrastructure side. So yeah, that just happened this week. But I think this is a really big deal, what's happening on this infrastructure side.
Absolutely it is. And I want to bring up an analogy. I know BlackRock's in the headlines, good sometimes, bad sometimes. Larry Fink has been polarizing in the past. I was visiting with a client this week, and he asked a question about BlackRock. And he had served on the board of a bank for a long time. And I asked him, if you're running a bank, is the money that you have deposited your money or the depositor's money? He said, well, it's the depositor's money. I said, so when you're making decisions on what you do with the money, are you doing it in the best interest of the shareholder or of the bank? Does the bank control that client's money, that depositor's money, or do you? He goes, well, we're a fiduciary. We do it on behalf of our clients, and our clients come first. Exact same thing with BlackRock. The only difference is y'all are using investors' money to go in and make good decisions and good investments that people can participate in. BlackRock doesn't have a board that controls clients' money, or BlackRock doesn't own those assets themselves. When they're investing in these ports, when they're investing in the data centers with Microsoft, when they're investing in the ERCOT electric grid or the water systems in Texas, BlackRock does not own, nor does BlackRock control that. They find good investment opportunities for the people that choose to work with BlackRock to manage their money. And I think that's really important to understand. That's capitalism in the United States. We don't necessarily want the government to control all that. I think the more private investors have the opportunity to invest, make money, make the country better. And our opinion is always better. And it's interesting to note that all those projects you just mentioned on the infrastructure side are private equity investments and private credit, so private bond issue investments. Right now in the United States, of every company that has $100 million or more in revenue, 87% of those are privately held. And so there's so many opportunities in the private markets, whether it's private bonds or private equity ownership. Most of those are in the private side, and BlackRock's very much invested in that. I just got back from a alternatives conference in Tampa Bay with Raymond James, where we were visiting with private equity and private credit companies. So the opportunities out there are very significant. In Texas and Columbus, Ohio, the Ohio area are two of the places in the United States that are going to see the most build out of AI infrastructure facilities. And so basically to do a search on ChatGPT to ask a question and to do it on Google, if I search what was the deal in the Panama Canal and why was it so important that the United States took control of the Panama Canal on Google, and I did the exact same search on ChatGPT, that search using artificial intelligence is going to be significantly more comprehensive. It's going to analyze the deal, and it's going to take 10 times the amount of electricity that asking that same question on a Google search will do. And Google search is basically going to redirect you to articles, but it's not going to disseminate and reason through what those articles have to say. With that increase in electricity usage, we have to have the data centers. We have to have the electric grids, and there's three main electric grids inside the United States. ERCOT's one, and then there's an eastern and a western side of the electric grid, and then a couple up in Canada. So very, very, very important that we build that out, because we want all our data, be it cloud storage, artificial intelligence, even cryptocurrency mines. We want those inside the United States versus them being outsourced to China, to India, and putting our data at risk. Because one of the most valuable commodities, one of the most precious commodities that's going to exist over the next 100 years is data. And it's interesting, Chad, if you go back to Adam and Eve, to the beginning of creation, up to 2022, and you think of all the data, all the information that existed in that period of time, from 2022, 2023, and 2024, we've doubled the amount of data that existed in human history up to that point, from Adam and Eve through the end of 2021. Every 3 years going forward, the amount of data that exists, as simple as taking a picture on your phone, sending an email, sending a text, data searches, information that's uploaded from companies, we're going to double our data every 3 years. And that's why it's so important for the United States to invest in these data centers close to Snyder by a lot of our offices in Abilene. Abilene is going to have one of the largest data centers that Blue Owl's building. Oracle has leased, and it has a 30-year lease to build a $2 billion project into West Texas. West Texas is going to see a lot of that infrastructure built out. Midlothian has a very big one south of the Metroplex. I believe Google runs that one. You're partnering with when I say you, BlackRock's partnering with Microsoft, and they have a permit to reopen 3 Mile Island, because in the United States, we're going to have to increase our electrical creation through coal, through primarily LNG, but also wind, also solar, geothermal, hydrocarbons, non-hydrocarbons. It's really exciting, all the investment that's going to take place in the United States over the next 10, 15, 20 years. In my opinion, my personal opinion, I think we're opening up to have one of the greatest 20 to 30 year periods in American history. Most of that is supported bipartisan, because we all know that we need it. No one wants to go through another time period with COVID where we don't have pharmaceuticals, we don't have chips for our car, we don't have access to internet. If Taiwan was to be invaded by China and then take over the chip business. So these are very critical things that BlackRock's involved in, other companies were involved in. But to get to that point, we have to go through some growing pains. And that's probably what you're going to see this year. Chad, if you would real quick touch on what is BlackRock's outlook for the economy this year? Do you think we're going to go into recession? Are we going to have growth? We've had 2 straight years where the market went up 20% per year in each of those years, which is extremely uncommon. The past 10 years, the S&P's averaged over 13%, which is above the historical average. Give us a little bit of insight of, even with these good things happening, what could investors experience on interest rates and on the markets going forward?
Yeah. So Russell, the way we think about this, really 3 main topics. And this is directly from Larry Fink and Rick Reeder, the head of BlackRock Fixed Income. They said there's 3 things you need to understand about this year. Number 1 is perspective. Number 2 is bifurcation. And number 3 is income. Okay, so I'll walk through those quickly. So perspective, what do I mean? It's really what you said, Russell. The last 10 to 15 years, the S&P's made 13 to 14% per year. Everybody needs to understand that's not normal. Okay, that's not normal. The last 2 years, the market made over 20% per year. That's not normal. So we do believe the next 10 years, the returns are likely to be 6 to 8 to 9%. They're not going to be 14 or 15%. Okay. So I think you've got to set your expectations. I know a lot of folks are really excited about all the pro-business things Russell and I are discussing, but there's a big difference between the economy and the stock market. Okay. So a lot of this is priced into a lot of these companies, especially on the technology side. A lot of the technology companies, you see them come out with earnings that are amazing and the stock goes down. And it's because they're priced to perfection. And so, Russell, I think you'll see some volatility in the market, but I think the economy is going to do extremely well. So we've got to have perspective and make sure we don't just expect the market to make 20% because there's really exciting things going on in the economy. The second thing is bifurcation. I think this is extremely important. And if you think about that 15-year period where the market did really well, it was really defined by what's called ZIRP, zero interest rate policy. We had a system, Russell, that actually rewarded debtors. The way I think about it, it's like removing the speed bumps from a parking lot or a school zone. If you do that, what are folks going to do? They're going to drive faster and they're going to take too much risk. And that's what happens when you have 0% interest rates. You reward debtors who take a lot of risk and put a lot of stress on the economy with silly things they do. Russell, this is the exact opposite. Today, interest rates are likely to stay around 4%. Okay? We don't see the Fed cutting rates this year. We don't see a recession, right? I think the growth of the economy is going to slow down, but I think what you're going to see is, even though the growth is slowing down, unemployment is likely to stay right around 4%, maybe a tick or, two higher than 4%, but 4.1, maybe 4.2%. So if we're employed, our wages are growing, we don't see a recession, but we think there's a big divide between companies. And let me talk about what I mean. So if you think about this, in 2020, when interest rates hit the 250-year low in the United States, the 10-year Treasury was 0.5%, August 4th of 2020, 0.52%. So what do you think all the best companies in the world did? They termed out their debt. It's like refinancing your mortgage. So 46% of the S&P 500 debt today matures after the year 2030. So a lot of the best companies, they termed out their debt at rates of 0.5 or 1% for 10 years. Now imagine trying to compete with an Amazon or a Walmart or an Eli Lilly that not only doesn't have to borrow any money, but they're sitting in cash making 4 and 5 and 6%. Berkshire, look at Warren Buffett, over $300 billion in cash making 5%. Now, what about a small business? They're struggling to stay alive. They need to borrow money. So they don't borrow money at 4 or 5% where the market is. They have to buy it at higher yields. It's called high yield bonds, junk bonds. They're going to borrow at 8 or 9%. So our best companies borrow nothing, and these small cap stocks have to borrow money at 8 or 9%. That's a massive divide in the economy. Now the small cap business is not sitting there making 5% on cash where the big companies are. So it puts them at a big disadvantage. Rick Reeder talked about this. His daughter's a buyer at Walmart. He's like, she has the craziest analytics and big data, artificial intelligence to help her know what to have on the shelf ordered and ready to go 6 months from now on a Monday versus 3 months from now on a Friday versus the Easter season this year, because the weather patterns. They study all of this. And imagine a small business doing this on a spreadsheet trying to compete with Walmart. So Russell, we had this bifurcation in the economy, and I think you and your team have done a great job of making sure you're positioned in these large cap, high quality U.S. companies. We have the best companies. The U.S. market is dominating. And so Russell, that's what we mean by bifurcation. The last way I would kind of describe that, imagine you have two families and you're trying to figure out who do we go have a summer vacation with. One family makes $100,000 and has a 2.7% 30-year mortgage. The other makes $100,000 and has a 7.5% 30-year mortgage. Russell, they're making the same thing. They're living a different life.
Right.
Because of interest rates. So when you have this pro-growth, pro-business economy, inflation is likely to be a little stickier. Rates are likely to stay a little higher. And so you have to understand that structure. So although we think the overall market might make 6 to 7%, We think there's a lot of large cap US companies that are going to make way more than that. And so you'll get this divide between the economy, and it won't be anything like the last 15 years. The last is income. And it's like, think about, I know there's folks listening to this that remember mortgage rates in the early 80s. My dad's like, you big baby, stop worrying about 5 or 6%. We had 15, 16, 18% mortgages in the early 80s because the 10-year treasury all-time high was September of 1981 at 15.8%. And Russell, August 4th of 2020, we got down to 0.52. So 90% of your return in fixed income and bonds for 40 years was from falling interest rates. That's over. It's not going to happen in the next couple of years. So you're going to make money from income, not from bond yields falling. And so you want to make sure your fixed income is positioned properly into some of the higher yielding instruments because we don't see a recession. And there's tremendous opportunities across the income landscape to make 5 or 6% without taking a lot of risk. So those are the three big themes, Russell, that we're talking about in this environment for this year. But the biggest thing, the last 2 years, everyone thought we were going to have a recession and the market went over 20%. The biggest problem with the market this year is everyone came into the year thinking we're going to go up 15 or 20%. So when everybody thinks that, it's going to be a little tougher than what folks thought. And that's what's happening right now.
Yeah, I think it's all about setting expectations for the next year. So as we adjust to all these new policies, a couple things I want to add to that. This is the 40-year anniversary of the NASDAQ. The NASDAQ 100, if you look at the 100 largest companies on the NASDAQ, only half of those companies actually have debt. The other half of the companies that do have debt earn enough on the cash that they have on their balance sheet to service their debt. That's absolutely mind-blowing. And that was on the NASDAQ website earlier last week. That is absolutely mind-blowing that a lot of companies are in such good shape. And so when you hear about going back through the dot-com bubble bust, it's very tough for a company to go broke if they have a lot of profit, a lot of cash, and no debt, which is a very good position to be in. Second point I wanted to make is when we invest in companies, not politicians. I know politics are very polarizing, but a lot of these things that we're talking about, you're investing in the companies in the United States, ran by 500 of the sharpest people there are on the S&P 500, the Fortune 500, brilliant minds that run these companies. You have 500 people in Congress that you can't, nor would you want to buy shares in. We're not buying shares in Elizabeth Warren or Ted Cruz or any of these people that are on the news constantly. We're buying interest and we're buying shares and we're loaning money to some of these massive companies in the United States, the Chevrons, the Exxons, the Apples, the Microsofts that are in tremendous shape and that have helped guide the way the United States has grown over the past 100 years and probably will be very involved in it in the future. And that's not a recommendation for any of those companies. It's just some names that we're all familiar with that dictate how this country operates, not the politicians. And I think that's always important to mention. Chad, the last thing I want to discuss today is there's been a major change in Social Security. I know there's a proposal out there that could be even a bigger benefit to Social Security with Social Security potentially not being taxed is one of the proposals that's out there right now. But there has been legislation that was passed that does affect a lot of our clients. Would you touch a little bit on the latest Social Security Act, what those changes are and how they could affect people?
Yeah, so this is really exciting. I've done 1,200 plus seminars on Social Security. I love this topic. I love trying to help people understand how to maximize their benefit because it allows you to lower the risk with their investments. So yeah, a huge change. The Social Security Fairness Act was signed into law by President Biden a couple of days before he left office. And what this does, it removes the windfall elimination provision and the government pension offset. Okay, so let's go through those two formulas quickly so everybody understands what's going to happen. So let's say you're a teacher and in Texas. Texas is one of the few states that has a setup like this. So a lot of folks are like, where is this money going to come from? They're going to give all these payments to. It affects about 3 million people across the country and almost 2 million of them are in Texas. Okay, to give you perspective on that. So the windfall elimination provision, I want you to, understand that's if you have your own Social Security benefit. So you have at least 40 quarters and you also have a non-covered pension. Now, non-covered pension just means you paid into a pension instead of a Social Security plan. So all you got to do is look at your Social Security statement, which I would encourage everyone to do, and have an account online. If you see zeros for all the years you were teaching, or you were a firefighter or a police officer or a government employee, and you see zeros for years you know you were working, you have a non-covered pension, which means your Social Security benefit that you qualified for was reduced by $300 to $500 a month every month simply because you had a non-covered pension. It didn't make any sense. It wasn't fair, and that is now gone. Okay, so if you have been receiving Social Security already because you qualify for a benefit, but you're a teacher, your benefit is being reduced by maybe $200, $300, $400, $500 a month. The cap is like $550 a month. If you're already receiving your benefit, you don't need to do anything, which is the best part. This month, you are going to start receiving a higher check moving forward to make up for that windfall elimination provision that was reducing your benefit. They're also going to retroactively pay you back to January of 2024. Okay? That is if your benefit is on record right now. Now, if you hear this and you're like, well, I don't have enough quarters. I have 30 quarters or 32 quarters or 36 quarters, but I never worried about getting the quarters because I knew they were going to reduce my benefit anyway. Please talk to Russell and his team. You need to figure out if you can get 40 quarters. Okay? And to get 40 quarters, you need to earn $1,200 in a quarter to earn a credit. You actually don't have to earn it in the actual quarter of the year. You can actually make $4,800 in 1 month this year and get 4 credits for 2025. You could work 1 month in 2026 and you could get 4 credits. You could get 8 credits over 2025 and 2026. You want to do that because you will qualify for that full benefit that you're entitled to. Okay? So that's windfall elimination provision. You have your own Social Security you qualify for, and you have a non-covered pension. Now, even more exciting, Russell, is on the other side, which is for spouses and widows. Maybe you have an ex-spouse. Maybe you have an ex-deceased spouse. And you haven't received anything because you have a pension. So I'll just give an example. Let's say that I have a $3,000 Social Security benefit and my wife, Lena, has a $3,000 TRS benefit. As my spouse, if we're married for 1 year, she qualifies for half of my benefit. But you had to do a calculation. They would take her TRS pension and multiply it by 2/3. So if I take $3,000 and multiply it by 2/3, that's $2,333. So that's her offset number on her TRS. That's called the government pension offset. Now I have a $3,000 benefit. So while I'm alive and we're married, she qualifies for half of it, which is $1,500. The problem is her offset is higher than what she's eligible to get from me as a spouse. So she gets zero. Starting this month, she is now going to get the $1,500 off of my benefit as a spouse, and she's going to get her full $3,000 pension. There will be no back pay because the benefit was not on record. Okay. So in that case, my wife would need to file an application for this spousal benefit now. Like this month, you should be filing. Social Security is a monthly accrual system. So it's not like you need to do it today, but if you do it during this month, you're going to get credit for this month and they will start paying you moving forward. Okay. Now, if you have an ex-spouse, okay, as long as you were married for 10 years and you have been divorced for 2 years and you're not remarried, it doesn't matter if your ex is remarried or not. As long as you and your ex are both 62, you are eligible for half of your ex's benefit, even if you're a teacher. Okay. Even if you have an offset number. So you are now eligible for that. If your spouse passes away, so I'll go back to my example. I have a $3,000 Social Security benefit. Alina has a $3,000 pension. With the GPO being removed, she is getting $1,500 a month while I'm alive. If I pass away, she will switch from the $1,500 up to the $3,000 and she'll get $3,000 in my survivor benefit and $3,000 from her TRS pension. Now, I'm just using those $3,000s as an example. That doesn't mean that's what you're going to get. But you want to check your statement. What is your spouse's benefit? What is your TRS benefit? If you're married or you've been divorced, but you were married 10 years, you qualify for that benefit. If your ex-spouse passes away, you are eligible to collect 100% of their benefit, regardless of your TRS pension or firefighter pension or police officer pension. So Russell, this is a monumental deal for folks that have either had their benefits reduced every month or they've been receiving nothing because of some offset number, right? I've got administrators I've helped that have a $5,000 pension from TRS, and it offset everything, even if their spouse has passed away. You are now eligible for that, but you have to initiate that. So you're going to need to file an application. I would tell you, you don't need to contact Social Security in most of these cases. You can go to socialsecurity.gov/apply, and you can file for these benefits online, and it takes less than 10 minutes in most cases. So Russell, this is a really big deal, and I'm always here to help you and your team if there's questions that come up.
And it's fascinating. Most people don't understand that it affected 3 million people, 2 million in Texas. That's a fascinating number. And it does affect a lot of our clients that were teachers and their spouse worked, or both of them were teachers. So very, very, very impactful. I appreciate you going over and explaining that to people. Chad, I want to thank you for being on the podcast today. Look forward to having you again, and appreciate all that you do to serve our clients.
Oh, this has been great. Just remember what I said up front. Don't look at the waves next to the boat. Things are going to be choppy in the short term, but I think like you said it, Russell, the golden age of investing, I think it's coming. That's what Rick Reeder says all the time. Our head of fixed, he's so excited about this is common sense, what we're doing, right? And so to let the capital markets and let the U.S. markets work, this is going to be fascinating. So appreciate the opportunity. I know how much all these clients mean to you. And so it's a blessing for me to be able to help you serve these folks. So thank you for having me.
Awesome. Thanks, Chad.
All right. Take care, buddy.